Schedule for the rest of the semester. So I want to take 2 minutes to review this with you guys because there's some things that are going to be important for you to be aware of. So we are right here, week 12. This week on Friday, you're going to have two things. One is a quiz and one is an extra credit assignment. The quiz will cover some short answer from chapter 8 and 9. And then there's one problem, I believe, from chapter 12. I have to go back and look at it. It's either chapter 9 or chapter 12. I think it's chapter 12. Then, in addition to that, for those of you that are interested, there is one problem to do from chapter 9. That's an extra credit problem at your option. I've not had a chance to finish completely grading the homework, so what I'm aiming to do is finish grading it tonight at some point, and then I'm probably going to do a short video on explaining that problem, or the problems from the homework that you all can reference. If for some reason you need a little bit more time beyond Friday for the extra credit problem, please just email me. I'd rather have you do it than not do it, okay? The other things that are in here. So next week is the week of Thanksgiving. Often I never have class on Wednesday because a lot of people are traveling, but given some things that I want you all to be doing on your neighborhood project, I'm making Monday a working session as well. So by kind of the end of day on Wednesday, you have an outline that needs to be prepared. So this is taking into consideration all the work that you've already done. Was an outline, just a Word document with a number of things that you're going to cover. There's some definition in there. You're welcome to turn it in sooner than Wednesday, but it really gives you kind of a couple of days to do that. Then when we come back after the week of Thanksgiving, what's going to happen? We're going to review chapter 13. We're going to do a couple of short quizzes. You'll have one more homework assignment. And then week 15, the week of December 5th, on Monday, we're going to do our review. And then right now, my plan is Wednesday and Friday to do the exams. It's a fairly, it's fairly short. It probably won't have a lot of questions, but those questions tend to have a lot involved in them because we're going to do at least one problem from chapter 9, which is a net present value evaluation. We're going to do probably one problem from chapter 13, which we'll learn about after Thanksgiving. And then included in there some way is going to be the topic we're going to talk about today. Okay, so that exam doesn't have a lot of questions, but the questions will be very involved. The other item of note, this quiz in week 15, I give you guys 70 points of quiz worth points. The total number of quizzes that are here in Moodle is worth 80 points. So that means that there's actually one of the quizzes that more or less can get dropped. This quiz is actually the sample exam. So if you work the sample exam as your quiz assignment, turn it in, that essentially gives you an additional 10 points of extra credit. So instead of having the base of the 7 assignments, you actually get one extra one. Helene? The quiz for this is due Monday by class. And then we'll review the sample test. This is the Monday, December the 5th. 5th. That's okay. It's the Monday after Thanksgiving. So you would naturally work the sample test anyway. You can work it, turn it in, and it gives you an opportunity. So there's about 20 points of extra credit left. The third exam, I don't typically have extra credit on it. The problems that we do take up so much time, there just isn't enough room to do that. So, for your reference there. Okay, then the final things that remain for the project. You're going to have a couple of things that you have to do, complete, / turn in. So one is I ask your team to do a practice run. It means you have to get together as a team and run through your presentation. Every team only has 15 minutes. It's surprising how many teams fit way too much content into your presentation. It takes a lot more time than 15 minutes. It's not very effective. So I actually have you do a practice run and turn that in via a video so that I know that you worked through it and that you can do it in 15 minutes. So I've made a note in that assignment that you all want to be thinking about when you're going to have time to do that as a team, because it's going to require your team to get together. The second thing is that everybody's going to turn in your PowerPoint that you're going to present. I'm having all the teams do it on Sunday because 3 teams are going to go on Monday and the other 4 teams are going to go on Friday because we have that gap for our class sessions, and it just feels fair to have everybody turn it in at the same time. The only exception to this is for the teams that go on Friday, you can turn in your practice run by end of day on Thursday with a minor point deduction. So you can have an extra 4 days to do it, but in doing so you have less maximum points. More time, less maximum points. It's only a point or 2, but I'm trying to align incentives. And then probably the Monday that we get back from Thanksgiving, I will have assigned teams randomly, i.e. I'm going to draw numbers out of a hat and put some teams on Monday, some teams on Friday, and then I will review that with you guys. It seems the fairest way to do it because there's such a time gap. Okay, and then if anybody has major issues, we could discuss and negotiate a day move from Monday to Friday or Friday to Monday. Okay, that's a lot, I know, but I just want to make sure that there's kind of a lot of things coming towards the end of the semester. But the good thing is the exam will be done prior to finals week. The last thing that I will say, I've taken all of your grades to this point, I put them in a spreadsheet, and I've done a little mini analysis that says of the remaining points, what percentage of them do you have to get certain grade levels? So if you're interested in knowing where you stand, after class for a few minutes, I'll sit out in the hallway and I can tell you. There's some of you that are on a bubble to go from one letter grade to the higher letter grade. That's a good thing to know because there's a lot of points remaining. Extra credit points are very significant. There are also some of you that are on a bubble to go the other way. And those of you that might be in that situation, I will let you know that because the third exam is challenging, as if the other ones haven't been challenging. The third one is challenging. So we want to make sure that doesn't work out against you, not in your favor. Okay, any questions about this? Or if you guys have a little time by the end of the week, make sure you run through all these assignments, put them in your calendar for the project, making sure you're working with your team. Okay, so 2 last things that I'm going to comment on when I was looking at the chapter 8 and 9 problems that I just want you all to be aware of as you work these. Some of you would benefit from actually levels of repetition. So if you all take a couple minutes and you look at the homework solutions that I've posted, each problem looks very similar. I don't deviate the structure. In this type of work, repetition is a good thing. When some of you looking at your quizzes and your homework, I saw one problem with kind of one structure, another problem with a slightly different structure. That is not always the best approach. Use a structure and to it. Ideally, use the structure I presented to you because it is the easiest way to do these things. And that way, you're not thinking about how do I format this, how do I do the analysis, just kind of follow a standard approach. The other thing that I saw, which I think is a good thing, is some of you using some of the more advanced Excel techniques, like the $ in front of the cell, column, and row to hold a cell constant. So when you copy it, it doesn't move, it locks that cell. But when you're using some of those more advanced Excel techniques, make sure that you're then going back and reviewing the details, because if you copy something and you change the discount rate, if you don't change the cell reference, you're using the original number. It doesn't, you have to go in and scrutinize some of your more sophisticated Excel techniques, okay? But otherwise, I really like what I saw. I think so far so good. We're going to actually, I mean, this may seem kind of weird after whatever, seems like 15 months of finance class, right? The first 11 weeks of our class, we've been sitting on the left side of the toolkit, learning about performance management and valuation of companies. Now, for the next couple of weeks, we're going to sit on the right side, which is talking much more about risk. And risk is very important in the context of finance because there is a saying that says the greater the risk, the greater the reward. Any of you taking American history lately? Have you guys studied like the gold rush in California? Or do you guys remember the gold rush in California from, I don't know, junior high history class? What was the gold rush in California, Robert?
When everyone went west because a couple people struck gold. There was kind of too many people that wanted, so barely anyone got it.
Yes. So there were a bunch of people that went out to California, got super rich, prospecting gold, and then everybody got really excited about that because you could make a ton of money. But then everybody who followed, all the gold had already been sort of recovered. But that's a very motivating thing, right? So it was a very risky thing to kind of pack up all your belongings and move to California. But the opportunity to strike it rich was so great that you just couldn't pass it up, okay? So there's some psychological phenomenon here, but there's also some proof of concept, especially in the financial markets. So we have to find ways to measure that. And then also, there are people who don't want risk, right? So any of you have grandparents? Now, your grandparents might be like my parents. You can tell me if this is true. My parents are very conservative. They don't like new things. If they could, they would take whatever their savings is and bury it in a hole in their backyard. The concept of them putting it in the stock market is crazy, okay? Now, I'm a little younger than them, a little older than you guys, but I like a little risk, right? But there are instances where we don't like risk. We want to get rid of it. So we can also talk about that and some of the mathematical concepts that help us assess how much risk there is and then figure out how to move some of that risk. Okay, now we're not going to do a ton of statistical analysis for our course, but we are going to apply some of these concepts. So with that background, if you remember when we talked about the stock market, we talked about rates of return. This becomes really important to continue with our discussion about risk. So there's the overall rate of return of a stock. So I have a couple of shares of Disney stock. I went to Walt Disney World this summer. We spent an arm and a leg, and so I felt like I needed to get some of my money back, so I bought some of their stock. Now, by owning a Disney share, and I think we bought it at like $95, today the price of the Disney share is $98. So already I've got $3 per share of goodness. On top of that, every quarter, the Walt Disney Corporation pays a dividend. So for every share, they might give me 50 cents. So I make some money on my investment through the rise in the share price and then getting that dividend. That's real money. So the dividend we call the dividend yield, and the rise in the share price we call the capital gain. When we measure rates of return of stocks, we have to have ways to benchmark them. And that's the focus of a lot of our conversation today. So, the stock market, we're going to work this kind of backwards. The stock market has some market indices. These are just a few examples of them. The Dow Jones, the S&P, the NASDAQ, the Russell, Dow Jones Transportation, okay? So I want you guys, since you guys have some computers up, go out, whatever your favorite browser is, Google, what have you, and type in companies in the Dow Jones Index. Okay, you guys type in companies in the S&P 500 index. And why don't you guys look at the NASDAQ index? What companies? And then you guys can look at the Russell. So you can just type in Russell 3000, Russell 2000, and then why don't you guys look at the Dow Jones Transportation. So what we want to unearth is what sits in these indices and why do we care. So you guys should come across stuff like this. So what kind of companies are in the Dow Jones? Colin? Sarah?
American Express,
Coca-Cola. Apple.
Goldman Sachs.
Goldman Sachs. Okay, so how would you guys describe characteristically those companies? Are they small? Are they big? Are they... They're ginormous. That's a... Ginormous is a great word. Right? Walmart is probably in this group. These are the biggest companies in the world. And it's 30 stocks. So what Dow does is they pick 30 industrial companies, which means that they're ginormous, and they put them in this basket. And that basket is a proxy for the measurement of the market. Okay, so what's the S&P 500? What kind of companies are in the S&P 500?
Amazon, AutoNation, AutoZone, Bank of America, Bed Bath & Beyond.
Ooh, all my favorites, right? So, also big companies. But instead of there being 30, there's 500 of them. So, Dow Jones is a financial information company. They're a business, and they've created this market index called the Dow Jones. The S&P 500, S&P is Standard & Poor's. They're also a financial information company. They've created a basket of 500 companies. And then they have a cumulative number. So when you guys see 2175 up there, that's the collection of those stock prices relative to the market. So what's the NASDAQ?
1-800-Flowers.
Yep.
Expedia. Etsy.
Uh-huh. So already, what's different about the NASDAQ? Smaller and?
Is it everything that's traded on the NASDAQ?
It's,
Or that's just...
yeah, it's a composite. So they put together, again, some index of what's traded. But these companies are, let me see if I can get the list up. They're different types of companies. Etsy, 1-800-Flowers, Expedia, right? Where are these companies? What are they maybe characteristically? How are they different than GE and Walmart? They're newer. They're tech-based. Okay, the NASDAQ is an electronic exchange. The New York Stock Exchange has humans for now. Right? So companies have a choice where they can list their stocks, right? But in general, the NASDAQ tends to be newer, more emergent companies, more tech-based, more disruptors, those sorts of things. Okay, so we have also the Russell. So what defines the Russell, whether it's 2,000 or 3,000?
2,000 or 3,000 businesses.
Yeah. And what does Russell put in their index? What kind of companies?
I was looking at their Wikipedia page. It says it has like 98% of the equity markets included in the Russell 2000. So it's a lot of big corporations like Berkshire Hathaway, Apple, and ExxonMobil.
Yeah, so it's just another, so Russell is another kind of investment company, right? And they have put together 2,000 companies that they're putting them together, and it's a collection of companies. And it allows them to, create financial products that stem off of that. All right. And then the last one, the Dow Jones Transportation, what's different about that versus industrials? Were you guys able to find that? So by transportation, without even looking at it, what kind of companies would be in the Dow Jones Transportation Index? Airlines, what other kinds? FedEx, companies that transport things and people. So what they've been able to do is create an index around an industry. So the Dow Jones Transportation measures how a particular industry is doing. And there's several of these industry type averages. So the opportunity here is to measure the financial markets from multiple different perspectives. Some of these are wrapped around information. Some of them are wrapped around financial products. You all can actually go out and buy what's known as an index stock. So you can buy the NASDAQ index, you could buy the S&P 500 index, and essentially you're buying the collection of stock, and as the market moves, your investment rises or falls. These are important because when we talk about the financial markets, these are the things that generally we're speaking of. Most of the time when people talk about the market, it's probably something like the Dow Jones. Might be the S&P. But when we consider that, that's what we're looking to. So this then forms the backdrop for how we measure stock market returns and how we start to assess risk and return. Financial investments and securities or stocks have been measured since the 1900s. And we measure three types of financial instruments: treasury bills, treasury bonds, and stocks. The treasury bill and the treasury bond are the financial instruments that are issued by the United States government, mostly to foreign corporations, foreign countries, and the general investing population. A treasury bill is a 3-month. The treasury bond has a longer term. So we talked about bonds. Those are just types of bonds, and they have different time horizons. Then the common stock market is what we just talked about: the Dow, the S&P, the NASDAQ. When we look at those as portfolios of financial instruments, each of them has a different level of risk. The idea is that the treasury bill is safe. It's backed by the faith and strength of the United States government. We'll speak about that as theory. Whether you guys think that's true or not is a different animal. But in theory, it's as safe as you can get. And on average, if you owned a treasury bill over a long period of time, it would generate a rate of return of 4%. 4%, barely above the rate of inflation. But 4% is not bad. And it's safe. You don't have to worry about it. The treasury bond, we are fairly certain of it still, but because it has this longer time horizon, 10 or more years, interest rates vary, but the interest rate, because of the coupon rate on the bond, is fixed. So you have a level of volatility. And then the third is the common stock, the most volatile, the most amount of risk. But at the same time, it has the greatest potential. If we go back and we measure, 115, 16 years, these are the average rates of return of each of those markets. So a little over 5 for treasury bonds, and then something-ish, that number 7 is probably a little bit high, given the last 7, 8 years. But the common stocks, we can assume something between like 8 and 10%. Well, that's substantially different than the bonds. So the question is, why do we have different rates of return? Well, it has to do with the fact that we have different levels of risk and different time horizons. Those rates of return influence, obviously, your gains. So if you put $1 in those markets, and I think I've showed this before, the T-bill is going to rise somewhat, the T-bond is going to rise a little bit more, and the stocks are going to make you wealthy, in theory, if you hold them for 100 and some years. Okay. This is return. But notice the zigzagginess of these lines. That's risk. Because if you're on the wrong side of that zigzag, you're going to be unhappy. And then this shows a year-by-year movement of the rates of the return. So it goes up, it goes down, it goes up, it goes down. It's a roller coaster. This then allows us to understand something that we call the risk premium. If I take on volatility, more risk, what little perk do I get? What bonus do I get? That's called a premium. So how much zhuzh does the risk add to my rate of return? Well, if we simply compare the differences, I know that if I go from a bill to a bond, I get another 1.5%, 1.2, something like that. That has to do with the difference in the time horizons. One is 3 months, one is 10 years. So simply by having these investments along different time horizons, I get a greater return. Because time has risk built into it. A lot could happen in 10 years. So we call this a maturity-based premium, where the average return goes up because of the time horizon. Common stocks, above and beyond the treasury bill, I get an extra 7.5%. That has to do with risk. Because these stocks, I can sell at any moment in time. Sell them tomorrow if I wanted to. So they're on they're on any time horizon I want them to be. The difference then in premium has to do with the risk of the stock over the bond. So I'm able to, just thinking this way, to quantify the differences. And then the question is, well, why do we care? Well, this whole class, you guys have been working with R. We've done it with time value of money. We've done it to look at perpetuities. We've done it to value cash flows. What is R? Well, R has to do with these rates of return in the stock market. And the stock market represents what investors expect. So if I'm an investor and I'm buying your stock, I bought my stock of Disney, I would love it if that stock could return to me what the market would. I'd love it if it was better than the market, given the risk of that company. We're going to talk about that in a moment. But we need a way, so then also if I work at Disney, I need to know what is the discount rate that I need to use to value all those projects. So this is where I go to figure that stuff out. Now the mathematical part, and I'm just going to demonstrate this for you all. We aren't going to do these calculations, but it's important to understand it because it becomes part of our language. To figure out the impact of the risk or the magnitude of it, we use the statistical concepts of variance and standard deviation. So the variance tells us essentially how far we are from the mean, and it's a measure of volatility. And then the standard deviation gives us the sense of the spread. So if I'm to understand what's going on with a stock, I want to understand what the average rate of return is and how much volatility I'm going to expect with that stock. And the reason that I want to understand that is because what I will aim to do is diversify my portfolio. Have you all heard this term before? Diversification? What does it mean, Diana? No, never heard it? James?
Don't follow your eggs.
Exactly. Exactly. So if I'm a little store and all I sell is ice cream, on cold, wintry days, I might not have a lot of sales. When it's summer and it's warm and it's beautiful, I might have a lot of sales of ice cream. So to diversify my business, to make it 12 months long, what I may want to do is start selling hot chocolate. That's diversification. And what it does is it allows, so instead of having volatility, I have smoothness. That's the concept of diversification. So I can do that with stocks as well, stocks and bonds. In order for me to diversify, I need to understand the kind of risks that exist. So we put them into two categories. The first one is called unique risk. So unique risks are particular to my company or my industry. So if I am in the ice cream business, the milk production of cows is a particular risk to my business. Trends around obesity and healthy eating are a risk to my business. The movement to have more sorbet and gelato can influence an ice cream business. Those are really unique to the selling of ice cream. I can also then diversify my portfolio. So if I'm an ice cream store and I see that milk production is going to be challenged, I can go out and I can start making sorbet. Or I could buy a company that makes sorbet, because sorbet doesn't need milk. We call unique risks also diversifiable risks. So I can put another thing with my business or another thing with my investment, and they counterbalance each other. So it's like sitting on a teeter-totter. When one goes up, the other one goes down, up and down. The other type of risk is the market risk. The principle here is I can do nothing about that. My business is going to go up and down no matter how effectively I manage it based on what the market does. So these are recessionary things, global things, weather, and we call them systematic risk. And even the best investor can't diversify those away. And those are important to understand. When we understand it, what we can then do is put together collections of individual stocks. and we can diversify our portfolios, right? So this is the example I just gave you. And it works because we can understand the movements of different stocks, and we can understand the trends historically. One has gone up at certain times, the other one has gone up at certain times, and ideally we can offset each other. So we have all this data. This becomes an important strategy that investors use. So we can think about this idea of risk. And then here is the statistical calculation. I'm just going to walk through it. We won't have to calculate it. So if we have an auto stock, so think somebody like Ford, General Motors, Tesla, somebody like that. And in a boom, these are different economic cycles. Boom is, caviar and champagne. Normal is maybe iced tea. And recession is you're only drinking water and you only get 2 cups a day. Tough times. In these different business cycles, we have measured, and historically for the auto stocks, they have these average rates of return. So in the boom, when people are champagne and caviar, they're going to go buy Cadillac Escalades. They're going to spend a lot of money on new cars. They might buy a new car a year earlier. So the rate of return on the stock is 18%. Normal, 5%. And in a recession, they decline. I can then put a probability on each of those. 1/3 of the time, we have each of those business cycles. And what that means is, for this auto stock, over a long period of time, a number of years, I would expect the rate of return to be 5%. So if I went out and I bought Ford, and I held it for 30, 40 years, I would assume that I should, on average, have a rate of return of 5% per year. This is per year. Okay. This is the mathematics. So this is a weighted average. When you see WTAV, it means weighted average. So the rate of return times the probability. So 1/3, 1/3, 1/3 gives you an average of 5. Yep. Now I can get fancy. Then I can start looking at my statistical analysis. This is where I bring together variance and standard deviation. So the question is, how wide is the rate of return on the stock, if you will, at any given time? That gets us to variance. And then the standard deviation, on average, how much does it vary from that middle point, that 5%? So this is this step 1, 2, 3, 4, 5. I'm not going to go into it in excruciating detail, but this is the mathematics of how to calculate a variance. And then to do a variance, you take the square root of the standard deviation. So in looking at this, I can look at it in a vacuum and just say, well, is 1/12 big? Is 10% big? I don't really know. I would have to measure it against other things. But the idea is, this is only one stock, and it has a variance of 1/12 and a standard deviation of almost 11%. Now what I can do is I can add another investment to my portfolio. So this spreadsheet looks like this. Here's the auto stock that we just talked about. 18.5, -8% for the rates of return. Robert, will you grab that? That's probably the pizza. This is the gold. Thank you. Just set it on the corner. Colin, if he needs a signature, just sign Pam Schilling. I can go out and I can buy gold. Okay, gold is a counter-cyclical investment. In the boom time, gold declines. It doesn't, do awesome. But when it's a recession, gold does fantastic. Okay. When I have these two, and it's weighted 75%, 25%. So 75% in the auto, 25% in gold. My expected rate of return, thank you, sir, is 4%. So when I just own Ford, it's 5%. When I just own gold, or when I add gold, excuse me, it's now 4%. But here's the thing. When I redo my variance and standard deviation, the mathematics work like this. Of the two stocks together, now my variance is 15. It was 112 before. 15 is a much smaller number. So if before the variance of Ford was this big, giant big, 3 feet wide, now the two stocks, the variance on that rate of return is much narrower. So if you think about it, if you ask yourself, well, what's the chances that I'm going to get 5% or get the 4%? This tells you that the chances of actually earning 4% is much better because the variance isn't as big. And the standard deviation is nil. It's like 3%, which means it's very likely that you're going to earn that 3% or that 4% on your expected rate of return because the difference from that average is tiny. The point of all of this is that we can put together a portfolio. What we give up is a little bit of the rate of return. We give up the joy of financial gain. But what we get is much less volatility. Gold has tremendous volatility. Gold actually has more volatility than the Ford stock or the auto stock. One alone, it's a very, very steep roller coaster. The two of them together, not so steep. But in order to get less steep of a roller coaster, you got to give up a little of the adrenaline rush. Okay? That is what the theory of diversification does for us. All right. So to wrap up our conversation, I'm going to talk about two main concepts. What we're going to do now is take that idea of risk and return and rate. And we're going to move to the company level. So what I just talked about has to do with the markets. How does that then translate to an individual company? So my company, Disney. Well, there's a couple of things that conceptually we want to do. The market is the collection of stocks as its return and its risk. That risk in the market has to do with that measurement against the treasury bill, the treasury bond, and the overall market rate of return. The question then becomes, number one, what is the risk of an individual company? And number two, what is the typical average rate of return of an individual company? And if I have those things along with the average return in the market, I can figure out the rate of return for my company. I do this with two concepts. The first is measuring the risk of the company. And we do this with a metric called beta. It's the Greek word letter beta. Beta is another statistical calculation. Back to my example of Ford. If I went over this period, 6 months, and I captured the rate of return of the market, in this case I've chosen the S&P 500, and then Ford's stock's rate of return. So on a monthly basis, Ford went down 10%, the S&P 500 went down 0.86%, and so on and so forth. What I can then do through my statistics is essentially capture each month what's the standard deviation from the average, what's that turn into in an annual standard deviation, so I'm doing it for the market and for Ford, so in this particular time horizon, and then I can calculate the beta of those, just some mathematical correlation between these two investments, the market and the stock. So beta comes out to be this number. That number has a particular meaning. So if the number is 1.0, what it means is that this stock is perfectly correlated to the market. It is like ballroom dancing. They move together, or synchronized diving or swimming. They move together in perfect alignment. That is 1. If you are greater than 1, if the company is greater than, what it means is that that company has more dramatic movement than the market. And you can see that. The market moved 1.48%. Ford moved 8.7%. So the way to think about a number greater than 1, when the market's good, the stock is better. When the market's bad, the stock is worse. So for a beta greater than 1, it's sort of high highs and low lows. That's the way to think about it. If it is less than 1, it's the opposite. I don't move as dramatically as the market does. And that does happen for some companies. The beta then reflects the risk of that company. I can calculate my company's risk relative to the stock market. I need this because my aim is to figure out the rate of return on my company's equity. The equity, the stock. This is only what I'm going to tell you about right now, only is for the equity. So if I was to sit back and to say, what should the rate of return of Disney be? Well, I need 3 ingredients. I need the risk of the stock, I need the rate of return on the market, and I need the rate of return of Disney. Those things become what we call the expected rate of return, and that is what is demanded by investors to put money into that stock. That expected rate of return has 2 things. One is I need to be compensated for the time value of money. I'm buying an investment, it's locked up, the company's going to have my money, and I'm not going to get it out for some period of time. That's the time value money. The second then is the risk premium. Again, that beta. The financial mechanism, or the theory that we use to determine this, it's called the capital asset pricing model. Some really smart people, actually from my business school, the University of Chicago, figured this out some time ago. So we call it CAPM, C-A-P-M. And the idea is we assume that the stock market is well diversified and we can measure this company's rate of return by looking at its risk. And it gives us a formula. That formula is down here. It represents a couple of things that we've just talked about. So the RF is known as the risk-free rate. That's the Treasury bill. So when you see RF, think T-bill, and then think it's something in the arena of 3 to 4%. Then we have RM, which is the market rate of return. And that's typically 8 to 10%. And then the B is my beta. That's for the company. What this RM minus RF represents is the market risk premium. So it's the difference between the T-bill rate and the market rate. So we call that the market risk premium. It's whatever you would earn by putting your money into the market above and beyond a Treasury bill. So this capital asset pricing model, what it gives us is the rate of return for the company. The expected rate of return for the company. So back to my Disney. I can go out and I can get the market RM, I can get the risk-free rate, and all I need is the beta for Disney, and then that would tell me what I could expect on my stock's rate of return. And it's a relatively simple calculation. So I go out, I get the risk-free rate, I get the market rate of return, find out the company's beta, and then I can measure my company's expected rate of return. The key here is that wording, expected. Right. So I bought, if I'm thinking about buying Disney stock tomorrow, I can get that expected rate of return in my head, and I can measure it against other things I might want to invest in. Now, 6 months later, 12 months later, 2 years later, I would have the actual rate of return. So we need all of this because we need to know the company's cost of capital. So this is something that becomes one ingredient into the company's cost of capital. And we'll come back to this when we talk about Chapter 13. Oh, I wanted to show you guys one more thing. These betas are published. It used to be all this stuff was secret. There, we finally have it. So if you want to know the beta of the Walt Disney Company, it's here. 1.43. So based on what I told you, what is the connection between the movement of me and the market? Very similar. It might move a little more aggressively than the market, but not a lot. 1.43 is pretty close to 1. Hayden?
Do betas have a cap at like 2 and 0?
No, but you won't see wide ranges. I mean, if you find a beta that's more than 3, that would be unusual. Unusual. Fantastic. So this is a lot of theory, but it sets up some of the last foundations of what we're doing.